Welcome back to What's Hot, What's Not, CRE. It's Friday, April 3rd, 2026, and today we're tracking where institutional capital is actually flowing right now. Not opinions, behavior. So, what's hot? Data centers are the undisputed leader. Occupancy is at 97%. Rents are at all-time highs. We're looking at nearly 100 gigawatts of new capacity coming by 2030, requiring an estimated $3 trillion in infrastructure investment. The big driver is that AI workloads are expected to represent half of all data center demand by 2030. Power availability has now become the #1 site selection factor, surpassing even location and cost. Industrial logistics are still strong, despite all the tariff noise. Nearshoring and onshoring continue driving demand for manufacturing facilities, while urban infill and big-box warehouses remain institutional favorites. The I-20 corridor across the Sun Belt in particular is seeing a lot of greenfield development momentum. And here's the sleeper play. The Midwest. Chicago, Columbus, Indianapolis, Milwaukee, Kansas City. All are projected to deliver the strongest risk-adjusted returns in 2026. Why? Supply discipline. Chicago is approaching 5% rent growth with very limited new inventory. Midwest markets are simply undervalued relative to their fundamentals. On the capital side, life companies are back and competing. They have increased allocations to CRE lending. Multifamily, industrial, and grocery-anchored retail are their favored sectors. We're seeing non-recourse terms with rate lock capability, and banks are actively competing for stabilized assets. Capital is available, but lenders want quality sponsors and durable cash flow. And finally, yes, retail. Grocery-anchored and neighborhood centers are posting the highest rent growth and lowest vacancy among all major asset classes. Limited new supply is creating real pricing power, and even malls are showing surprising strength in high-traffic locations. Now, for what's not. Office distress is still elevated. Distressed office deals hit a 10-year high in 2025. Older buildings without modern amenities are struggling to find buyers. While national vacancy improved slightly, the bifurcation is severe. Class A trophy assets are performing, but everything else is under pressure. Capital is also cautious on Sunbelt multifamily oversupply. Austin, Phoenix, and Nashville are still absorbing all the deliveries from 2023 to 2025. Investors are avoiding new construction in these high-supply metros until the fundamentals stabilize. And with commodity industrial, you have to watch the tariff exposure. Trade policy uncertainty is creating hesitation on logistics assets tied to import-heavy supply chains. So why does this matter? Q1 2026 transaction volume is projected to exceed $66 billion, slightly ahead of Q1 2025. Commercial mortgage originations are forecast to increase 27% this year. Capital is re-entering, but deployment is selective. The theme is quality over quantity. Proven sponsors, durable cash flow, and supply-constrained markets. Your investor takeaway is simple. Follow the capital. Data centers and industrial logistics lead the pack. Midwest markets are offering the best risk-adjusted returns. Life companies and banks are competing for quality deals. Avoid commodity office and oversupplied Sunbelt multifamily. Smart money is moving, but it's moving selectively. That's your capital flows update. Thanks for tuning in. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter.